I mentioned tariffs. This is probably not getting as much headline as it should, but when you look at what's happened, you see the April Liberation Day with the increase in tariffs, but we've actually come back down significantly, and it's a lot of the impact of tariffs are starting to roll off, which is why we subscribe to a lot of different data sources, and the majority of the data sources are coming back to us as they read data with the same response, which is they don't see the pressures to inflation in the second half of the year, specifically tariff related inflation, like we have in the past. And they believe that that's actually going to help get us back to a lower inflation number. But this is, again, a big TBD. And obviously, we operate in a time where Trump can put a tweet out today and implement more tariffs, and all of this data goes, in the trash can. March is showing strong employment. So why are we saying that there's not recession, and why is the consumer still, driving the economy towards growth? Is because unemployment has held. We're at 4.3%. Anything below 6% is full employment. We have just not seen the unemployment rate tick up as the way that we thought we would, or that many prognosticators predicted. And the reason why is this chart here. And some of you on this call might be operating in this mindset. We're operating in a no hire, no fire labor market. When I talk to our institutional and company clients and I ask them about what they're doing, they're not laying off, but they are not hiring. And if they do lay off, they're replacing with AI. And I think next month, we're going to start to see in the jobs data, there's going to be a new line that talks about jobs that have been let go and replaced by AI. So we're now going to start to get a more transparency on the impact of AI on the labor market, which I think is a big story longer term. I'm very confident that you're going to see the impact of AI in the labor market in 2027. The question is will it creep into 2026? And now we're going to be able to track that. Consumption. And I think this is where the data is probably getting the most noise, and where we have to be very mindful of what's going on in the marketplace and what's going on with citizens that are operating in the U.S. economy today. If you've not heard this term, I would encourage you to get familiar with it, because we are operating in what's called, I'm going to do my hand, see if I can make it work like I guess like this. We're operating in what's called a K economy, K like kangaroo, where 20% of Americans who are in the upper end of the income strata are spending 80% of the dollars. 80% of Americans that are operating in middle class or below are spending 20% of the dollars. And so what's happening right now is that this real spending and this growth is coming from a smaller percentage of Americans, but that smaller percentage is spending more than the 80% of the majority of Americans. And this goes back to the COVID conversations that we were having in webinars, and Stuart's going to remember these comments. If you were an asset owner during COVID, that was the place to be. Why? Because your house was worth more. Your cars were worth more. I mean, think about it. We lived through an environment where car dealerships were getting premiums over the sticker price. We'll probably never see that again in our lifetime. If you owned your business, you got paid more of, and many of you on this call have been the benefactor of that. And specifically, if you had 401ks or if you owned investment assets, you benefited from that. But a significant portion of our economy and citizens in our economy are not owners, they're loaners. They have high debt, they have student loan debt, they have credit card debt, they have house debt, car debt, and anyone that is a loaner is probably finding themselves in the bottom end of that K economy, which makes the current environment very challenging. Because I got bad news for folks, and I don't know why this narrative is getting messed up in the newspapers and the TVs. When you go to Kroger and when you go to Publix and when you go to Ingles or wherever you go to get groceries, when groceries spike the way they did coming out of COVID, they don't go back down typically. And there's nothing regulating those grocery stores to force them to come back down. And so when we talk about inflation, we have to understand the fact that when, I'll mention this, when this Coca-Cola goes to $1.50, It's not going back to 50 cents like it was, 20 years ago when you could put 2 quarters into the Coke machine.